In order to be able to live off dividends, investors need to construct a diversified portfolio of dividend-paying investments that'll provide enough income in order to cover all of your expenses. While you can rely solely on dividend growth stocks like Johnson & Johnson, I personally prefer to look at investments that offer investors above average dividend yields. If you're not aware, there's a trend on YouTube where people are making their own tier lists and are ranking a variety of different things, such as US presidents, dog breeds, movies, video games, and etc. And it's all up to the personal opinion of the creator to decide which item goes where in terms of its ranking on the tier list. So I figured in today's video I'd do something a little different by joining in on this trend by ranking various dividend investment types according to my own personal opinion. Here's the tier list I'll be using for this video. The very top of the tier list next to the red box is where I'll be putting my absolute favorite dividend investments, and then at the very bottom next to the green is where I'll be putting my least favorite dividend investment types. And there can be more than one investment type next to each colored box. The types of investments I'm going to be ranking today are REITs, BDCs, closed-end funds, covered call ETFs, master limited partnerships, and exchange-traded notes. I'm going to introduce each one, describe how they function, discuss the pros and cons of each, and then provide my reasoning as to why I ranked it where I did. Keep in mind that how I rank each of these is completely my own personal opinion, and you're free to disagree with how I rank these. If you did your own tier list, you might have a vastly different ranking for each than I do. And that's because a lot of factors go into ranking each investment type that are dependent on each person's risk preferences, age, life circumstances, how much you have saved up, among a lot of other factors. Just because I give one investment type a lower rating doesn't mean I think it's a bad investment overall. A good dividend portfolio is one that's very well diversified among many different types of holdings, which for you may include every type that's featured on this list. So just keep that in mind. How I rank these is based solely on my own opinions. So with that being said, let's get started. The first dividend investment I'm going to discuss are REITs, or real estate investment trusts. And I'm just going to say it right now that I absolutely love REITs. These are one of the oldest dividend investments out there besides your typical dividend stock. For those of you who might not be familiar, a REIT is a company that owns, operates, or finances income-generating real estate. They're by law required to pass on 90% of their earnings onto investors in the form of dividends. There's two types of REITs, equity REITs and mortgage REITs. Equity REITs own physical properties and collect rent from their tenants, whereas mortgage REITs provide financing by purchasing or originating mortgages and mortgage-backed securities and earning income from the interest. There's over 160 REITs that are publicly listed in the United States, and you can find a REIT that collects rent from a variety of different real estate types, including office buildings, shopping centers, apartments, hotels, casinos, government buildings, farmland, and others. There's even a REIT that owns US post office buildings. One of the biggest advantages to REITs is that it might be the easiest way possible to invest in real estate. All you need is a brokerage account and you can easily buy shares of a REIT as long as the stock market is open. You don't have to worry about purchasing buildings yourself, finding tenants, evicting residents, or dealing with maintenance issues. You can technically buy one share of the cheapest REIT out there and legally call yourself a real estate investor. Many REITs have long track records of increasing their dividends as well, although equity REITs have a better track record when it comes to growing their dividends. Some examples of REITs include Realty Income, ticker symbol O, WP Carey, ticker symbol WPC, and Annaly Capital Management, ticker symbol NLY. Additionally, there's quite a few REITs out there that pay dividends monthly as opposed to quarterly. While REITs are considered one of the safer dividend investment types in this video, they're also one of the lowest yielding in this video. The average dividend yield for an equity REIT is around 4%, whereas for mortgage REITs, it's around 8% on average. The majority of mortgage REITs out there have seen an overall decrease in their dividend amount since their inception. Despite the couple negatives I just mentioned, REITs are easily one of the best investment types for someone who's looking for a higher dividend and isn't too favorable of risk. Additionally, there's a ton of REIT ETFs out there for people who want more safety with diversification. Because of this, I'm going to place this one at the very top here. Next up are BDCs, or business development companies. BDCs are companies that invest in small to medium-sized businesses in order to help them grow. In fact, BDCs and venture capital funds are actually pretty similar to one another, except you don't have to be an accredited investor in order to invest in a BDC since they're publicly traded companies. Much like REITs, BDCs are also required to pass on 90% of their earnings back to shareholders in the form of dividends. Here's a graph I made a little while ago explaining how they work. At the top left, you have your BDC, which will use Ares Capital for this example. Aries will invest money into a small or a medium-sized business, and the reason these companies approach BDCs for funding in the first place is for several reasons. It could be that they're too big to go to a local bank and ask for a loan, but they're not quite big enough yet to become a publicly listed company. Or it could just be that they don't like the other offers given to them by other institutions willing to loan them money. If the business is able to secure funding from the BDC, they'll agree to share a certain amount of the profits with them. Once the BDC receives their share of the profits, they then have to pay 90% of their earnings to shareholders, as I previously mentioned. Some popular business development companies out there would include Ares Capital Corporation, ticker symbol ARCC, Main Street Capital, ticker symbol MAIN, who also pay monthly dividends, and Prospect Capital, ticker symbol PSEC, who also pay monthly. BDCs typically offer dividend yields much higher than equity REITs. The average dividend yield for a business development company is around 8% or so, and while most pay quarterly dividends, there are a few that do pay monthly. In general, BDCs are considered riskier investments than REITs. It's not uncommon for a small company a BDC lends money to go bankrupt, which during recessions can cause a lot of strain for the BDC sector. Most business development companies also don't have a great track record in terms of growing their dividends over the long term. Ares, which is one of my favorite BDCs, has a 5-year dividend growth rate of only 0.87% according to Seeking Alpha. Main Street Capital only has a 5-year growth rate of 2.68%. So while the dividends are great, total appreciation is going to be less if that's really important to you. I'm still a pretty big fan of BDCs though, and I always make sure to reinvest those dividends. Because of that, I'm going to put BDCs right here. Now let's talk about MLPs, or Master Limited Partnerships. These are a type of organization that are basically treated like a publicly traded partnership. They've been around since the 1980s, but today they primarily operate in the natural resource sector. Just like REITs and BDCs, MLPs get to avoid paying a lot in taxes in exchange for passing on their earnings to shareholders. One of the best benefits of MLPs is that some of them offer insanely high and oftentimes still growing dividend yields. It's not uncommon for some MLPs to offer dividend yields of 10% or more. A couple examples would include Cross America Partners, ticker symbol CAPL, with a nice dividend yield of 11.66%, as well as Icon Enterprises, ticker symbol IEP, that offers an insane dividend yield of 13.73%, and they've continued to increase it regularly up until this point. While all of this sounds fantastic, it's absolutely essential that we cover the biggest downside to investing in MLPs, and that's the K-1 tax form. If you invest in a BDC, a REIT, closed-end fund, or a variety of other dividend investments, you won't get any kind of unusual tax forms for owning them. But with MLPs, they're a little different in that when you invest in one, you'll also be sent a K-1 tax form. These things are notoriously difficult for the average investor to deal with and oftentimes require the assistance of a tax professional. What makes things worse is that if the MLP operates in multiple states, you might be required to file a state income tax for every single state that the MLP operates in, which can obviously be a tremendous headache. I personally don't know how K-1 tax forms are dealt with if you're outside the US, so I don't know if that makes it extra difficult or not. But the good news is, if you invest in an MLP ETF, such as the Global X MLP ETF, you won't have to deal with a K-1 tax form. But in ranking each investment type, I'm going to assume that you're buying shares of individual companies and not ETFs. Because of the K-1, I've personally never invested in an MLP as I personally don't want to have to deal with the extra headache. But MLPs might be a good option for you if you're particularly savvy with tax filing. I've also read that there's an additional benefit to owning MLPs in terms of estate planning in the US. If you're interested, you can study for yourself, but apparently beneficiaries can avoid paying taxes when shares are passed on to them. But because of the complex tax situation, I'm going to place MLPs here. Again, I'm not saying they're a bad investment overall, and they might be more appropriate for you personally, but I myself, as well as I'd assume the majority of investors out there, don't want to have to deal with the complex taxes associated with individual MLPs. Now let's look at closed-end funds, or CEFs. In many ways, CEFs hold a lot of similarities to ETFs and mutual funds, but there are some distinct differences. While these funds do hold a collection of securities, each CEF raises money from an initial public offering. They're closed-ended as opposed to open-ended, meaning that they can't issue an unlimited amount of new shares. Closed-end funds are almost always actively managed as opposed to passively managed. This means that fund managers hand-pick goes into each fund, which in turn means that CEFs usually charge higher fees than passively managed ETFs. It's actually not uncommon for a CEF to come with an expense ratio between 1 and 2% or more, which is higher than passively managed ETFs, which have an expense ratio average of 0.44%. The higher expense ratio means that fees will have a bigger impact on the long-term capital appreciation of your investment. Despite the high fees and the fixed amount of shares out there, one strength of CEFs is that they can use leverage, which ETFs can't. Closed-end funds use leverage as a way of increasing their dividends. Many CEFs have dividend yields of over 4%, and it's not uncommon for some to have yields of over 6%. Some have even higher dividend yields, with one of the most popular CEFs being ticker symbol CLM, which currently has a dividend yield of over 15%. I've researched hundreds of these funds over the years, and to be honest, I haven't been too impressed with a lot of them. I'd say the majority of CEFs I've come across have a history of decreasing their dividends over time, not increasing. Despite that though, many CEFs do pay monthly dividends, which is great for people looking for more dividends. For these reasons, I'd probably put CEFs right here on my list. Next up are covered call ETFs. These are exchange-traded funds that in some capacity use call options, which in turn are used to provide investors with exceptionally high dividends on a monthly basis. I've talked a lot about these kind of ETFs before on this channel, and they're currently the largest investment I have in my portfolio. The three most popular funds associated with this strategy are QYLD, which is so popular that there's even a subreddit for fans of it, and then there's also JEPI by JP Morgan, which also holds a good amount of equity-linked notes in it, and then finally there's NUSI, that in addition to writing covered calls, also uses protective puts for downside protection. JEPI and NUSI are actively managed, while QYLD is a passively managed ETF. If you want more information on covered call ETFs, I made a video last month in which I go into more detail on how they function. But there's so many good reasons as to why I love covered call ETFs. Like I just mentioned, they all pay dividends monthly, and not only that, but they also offer really high and growing dividend yields. QYLD currently yields 11.8%, whereas JEPI and NUSI offer lower dividend yields between 7 and 8%, but both of these funds have historically offered better long-term appreciation than QYLD. With these sky-high and growing dividends offered by these covered call ETFs on a monthly basis, you can really get a snowball effect rolling with your dividend portfolio much faster. While I consider these funds to be riskier than some of the other items on this list, the fact that they're diversified ETFs and not individual companies does help in terms of safety. One downside for a certain group of people would be that the amount these ETFs pay in dividends varies from month to month. Next month's dividend could be more or less than the previous month, so if you're looking for a monthly dividend that pays the exact same every single month, covered call ETFs probably aren't going to be in your best interest. But because of the positives I just mentioned, I'm placing covered call ETFs in the very top box along with REITs. I just love the high monthly dividends I receive now, along with the growth that comes with them. Finally, let's look at exchange-traded notes, or ETNs. This is a type of investment that's much less common than the others I've talked about so far, and there's a reason why. Exchange-traded notes are very risky. In my opinion, they're by far the riskiest type of investment on this list. There aren't too many ETNs out there that have a high enough trading volume. The reason why ETNs are so risky is because the issuing financial institution of these ETNs can basically delist them anytime they want. This happened not too long ago with the UBS eTrax Monthly Pay 2x Leveraged Mortgage REIT ETN, which was ticker symbol MORL. There's a really interesting article in Forbes that talks about it. The fund collapsed, and basically any amount of money you would have had invested in it would have been completely wiped out. So with potentially such a high amount of risk involved, why would anyone want to invest in exchange-traded notes? The answer is for the incredible dividend yields. One exchange-traded note, ticker symbol SLVO, currently yields 31.53%, which is enormous. Even MORL at one point was offering investors a 25% dividend yield. That means that if you would have invested $100,000 into an ETN yielding 25%, you'd be receiving $2,000 every single month. Sounds great, right? But remember, MORL collapsed, so that investment would have been completely wiped out. ETNs are definitely not for the risk-averse investor, but it's hard to deny how appealing those dividend yields are. While you're free to do whatever you want, if you do consider investing in an ETN, I'd strongly encourage you not to invest too heavily in one. I should also mention that the long-term growth of these funds isn't very good unless you're reinvesting those dividends. So for all these reasons I just mentioned, if I had to rank ETNs, I would probably place them right maybe here. I consider myself to be more tolerant of risk, but even the thought of owning a lot of ETNs, I have to admit, does make me a little nervous. I have seen people own tens of thousands of dollars worth of these ETNs, and I'm just not comfortable with that much personally. Okay, everyone, that's going to be my tier list. Again, these are my own personal opinions, and you're free to rank these differently for yourself. I would be interested to know how you guys think I did, though. Would you rank one or several of these higher or lower? Feel free to leave a comment below about what investments you think are best and which ones you particularly don't like. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.